Welcome to this explainer. Today, we're going to cut right through the usual market noise and zero in on exactly how to track true smart money conviction. Look, as a professional, your time and your capital are literally your most valuable assets. You just can't afford to base your moves on temporary market enthusiasm, right? You need a structural edge. So, think of me as your mentor for the next few minutes. We're going to decode the precise data that the most successful institutional traders rely on to validate their decisions. Together, we'll transform that raw, kind of overwhelming matrix data into immediate, actionable intelligence.
So, I want you to ask yourself, is that market rally you're seeing real conviction, or is it just a trap? We see it happen all the time, don't we? The market suddenly spikes, retail traders rush in with major FOMO, and then the bottom just completely falls out. As an executive, you absolutely do not have time to lose capital on fake trends. You have to know if the money moving the market today is actually going to stick around tomorrow.
To get us there, we've got a really solid 6-part game plan. We'll quickly cover the 2 pillars, then move on to decoding the options matrix, break down the 4 market scenarios, look at a live chart application, walk through some common traps to avoid, and finish up with an executive practice drill to lock it all in.
Let's dive right into part 1, the 2 pillars, differentiating noise from conviction.
We really need to shift your paradigm here by separating the noise from actual financial conviction. Think of volume as simply your noise meter. It tells you all about today's excitement and enthusiasm. Sure, high volume means there's a ton of action happening right now, but it definitely doesn't guarantee that the action will last. Open interest, or OI, on the other hand, that is your commitment meter. That's tomorrow's conviction. When open interest is rising, it means entirely new money is flowing into the market, and that is what tells you the current trend has genuine, lasting conviction behind it. Just to make sure our foundation is completely rock solid before we go deeper, let's clearly define open interest. It's the total number of outstanding, not yet closed, futures or options contracts. Think of it like a handshake. If I buy a contract and you sell me that contract, open interest goes up by exactly 1. It only drops when we both close our positions. Because it requires capital to be tied up, it is essentially the ultimate lie detector for market trends.
Moving right along to part 2, decoding the options matrix, translating raw data into smart money bias. Now, this matrix might look a bit intimidating, but it reveals exactly what traders intend to do once you know the code. This is an actual snapshot of a gold futures options matrix. Let's break it down. The rows are your strike prices. The columns show the days to expiration, or DTE, and they're separated by calls and puts. The numbers themselves, they represent the change in open interest. So a positive number means new contracts were added, and a negative number means existing contracts were closed out. For example, if you track the 4,500 strike row over to the 0 DTE puts column, you see a positive 147. That means traders are laying down 147 fresh bets that the price is going to drop. It is a direct window into institutional bias.
But here's the thing. You can't just stare at the raw numbers. You have to factor in the time horizon. 0 DTE is ultra short term. We're talking minute-by-minute sentiment here, and frankly, it's mostly just noise. What's super interesting is that if you want to find reliable swing trades, you simply ignore that noise and focus on the 23 to 56 DTE ranges. That is the sweet spot. That's where you'll find the medium-term, 2-month conviction bets that the smart money is putting down. We ignore the noise and we follow the conviction.
Which brings us to part 3, the 4 market scenarios. This is the core executive mental model you really need to internalize. I actually want to slow down a second here because this right here is your ultimate cheat sheet. Notice the crucial pattern in these scenarios. Rising open interest brings conviction to whatever direction the price is currently moving. Okay, let's walk through it. If the price is moving up, volume is high, and open interest is rising, that is strong bullish. Your action? Buy on pullbacks. But look closely at that second scenario. If the price is going down, volume is high, and open interest is still going up, that is strong bearish. It means new sellers are rushing in with massive conviction, so you sell on rallies. On the flip side, a rising price with falling OI. That's just a weak, forced rally. Usually short sellers desperately covering their positions to exit. Definitely don't buy into that. And that highlights something incredibly important. A single matrix number absolutely does not tell you the direction. If you just see a positive 200, all that tells you is that 200 contracts were added. It does not automatically mean the market is feeling bullish. You have to combine that number with whether it's a call or a put, what the price action is doing around that strike, and the expiration date. Context is quite literally everything.
Let's see how this works in practice with part 4.
Live chart application connecting the matrix to the chart.
Here is your practical step-by-step field manual. Step 1. Identify your bias from the matrix. Let's say you notice puts are increasing while calls are decreasing. Okay, that gives you a bearish bias. Step 2. And listen, this is the absolute secret to protecting your capital. You wait patiently for chart confirmation. You want to see the price actually drop below a key support level, backed by volume and open interest that are both sitting higher than their 20-period averages. Once all three of those signals perfectly align, step 3 is entering the trade safely right alongside the smart money.
And why are we so patient about getting that confirmation? Well, in the standard gold futures trade, using this exact setup we just went over, a 30-point drop yields a hypothetical profit of $3,000 per contract. High rewards come directly to those who patiently wait for price, volume, and open interest to completely confirm a strong market scenario before risking a single dime.
All right, let's talk defense. Part 5, Common Traps to Avoid. We need to navigate this minefield.
As a professional, protecting your downside is just as critical as chasing the upside. So whatever you do, do not step on these landmines. First off, never buy just because open interest is high. Remember what we said? Rising OI and a downtrend means new sellers are overpowering the market. Second, do not ignore those expiration dates. If you try to trade the 0 DTE noise, you are going to get chopped up, plain and simple. Third, don't jump on the very first OI spike you see. It's often just institutional hedging. Be patient and wait for a second day to confirm the trend. And lastly, never use open interest in a total vacuum. Without checking the volume and price context, it's pretty much useless.
Let this quote from our source material become your new trading mantra. The matrix gives you clues, the chart gives you confirmation. You must always demand cross-verification before risking any of your capital. Let the matrix give you a peek at what the smart money is thinking, but force the chart to prove that they're actually executing on it.
Let's wrap things up with Part 6, an executive practice drill to pressure test your market reads.
All right, let's bring the energy up. I want to pressure test what we've covered to ensure this framework is really locked in. Question 1. Think fast. True or false? Rising open interest always means the market is bullish.
The answer is false. Remember, rising open interest simply means new positions are entering the market. If the price is falling while that open interest rises, that is strong bearish. It means short sellers are actively stepping on the gas.
Okay, question 2. Let's test how well you read the matrix. At strike 4600, you see negative 335 calls for the 56-day expiration. Is that a bullish or a bearish signal?
If you said bearish, you nailed it. A negative number means existing contracts are being closed out. Smart money is actively abandoning their upside debts because they expect the price will fail to break 4,600 over the next 2 months. They're pulling their money right out of the bullish scenario.
Final question to really bring it all together. You look at your chart, you see the price is falling, you see volume is high, and you see open interest is rising. What exactly is the market telling you? It's telling you a remarkably strong downtrend is in effect, and you should be looking to sell on any small rallies. The conviction there is absolutely real.
Well, you now have the executive framework to read the market's true intentions. So I'll leave you with this final thought. The very next time you see a massive market rally plastered all over the financial news, are you going to blindly buy into the noise? Or will you check your matrix, read your chart, and wait to see if the smart money is actually committing? Use this system, protect your capital, and go trade with true conviction.